I guess you could say I am in the economic and financial gloom and doom business. And thanks to this body, President Obama, the Federal Reserve, business is booming. And, I would rather profit from America's success rather than her failure, which is the reason that I'm here today.
Portland seeing yet another week of violence. The city's mayor condemning rioters for trying to set fire to a police precinct.
It's like, well, I've been nibbling because the market just came down too much.
Yeah.
I mean, you don't need to be a rocket scientist to just judge it on the surface, right? The market was down a lot. A guy like that looks at it and says, this is kind of ridiculous now.
That the amount of credit in the economy at that point was bigger than the 1880s and the 1920s. And why is that significant? Because we had a depression in 1892, we had a depression in 1931. So RBA says 2007, the debt was bigger than those periods. Well, today, the debt is substantially larger than 2007. So the level of household debt, but also you look at the foreign debt.
Rebalance, et cetera, you get into the first couple weeks of the year and then you revert right back to the place where we've been. Worried about the Fed, worried about their message, worried about trade, worried about tweets, and everything else comes right back front and center.
They are, by extension, saying the economy is in worse shape than we thought it was.
A's, 0. B's, 0. Double B's, 0. Triple B's, 0. And then that happens.
I'm going to start by reversing the Trump tax cuts for the super wealthy and corporations.
Channeling a lot of that money into money for the poor. $6,000 a year that would be issued.
Funding pressures in money markets were elevated this week, and the effective federal funds rate rose above the top of its target range yesterday. While these issues are important for market functioning and market participants, they have no implications for the economy or the stance of monetary policy.
If a, quote, great deal isn't reached with China on trade, the president says he will impose new tariffs on the $257 billion worth of Chinese imports that have yet to be touched by the trade war.
Was back in late December when Lee first warned friends on WeChat about a SARS-like disease going around. Lee sent a group message saying that a test result from a patient quarantined at the hospital where he worked showed a patient had a coronavirus. He agreed to sign this document, admitting to spreading rumors online and severely disrupting social order. It reads, "We want you to cooperate with the police and listen to our reminder and stop the illegal act. Can you do that?" Lee answered, "Yes, I can."
Has identified the cause of the mysterious pneumonia outbreak in Wuhan City. And it's from the same family that caused the deadly SARS epidemic 17 years ago.
Oh, it has made matters worse in terms of opening the schools. So we've increased our number because the Association of School Superintendents say we need at least $200 billion in order to safely open the schools, and that does not include $4 billion. They're very precise.
Government stimulus will never grow this economy. It will never create jobs. It is the equivalent of trying to put out a fire by pouring gasoline on it.
What if I told you that in December of 2018, I decided to sell every bit and morsel of my stocks to make a portfolio entirely comprised of precious metals, gold and silver, physical gold, ETF-based holdings of gold or silver, and gold and silver mining stocks, which are companies that are incredibly difficult to value, and only because the product they sell is a commodity, where nobody sets the future price. This isn't like investing in an ordinary company, and this portfolio isn't like investing in a company at all, where the success is dependent on the success of a business. That's much of the reason why I got out of stocks to begin with. It's not been true anymore. Cash flow didn't matter. It was no longer an important metric to the valuation. The stocks had risen in failure, the stocks had risen in success, and they failed to account for the light rumbling of an earthquake we've not yet begun to feel. The movement into metals is a macroeconomic belief. It's led me to pay attention to these gold mining companies. It's not as though they have any better insights into the price of gold as compared with any other analyst out there, but their behavior is important nonetheless. Think about it. They constantly give away what their belief is for gold and silver pricing, be it now or the future, and what they're hoping for. Hope, mostly, in fact. Gold companies that build inventories rather than cash out on a sale are telling you they'd like to think that there will be higher prices, and they believe in the idea more than they believe they should sell the gold to make cash. Expand their mining operations. You can do that with cash, and or increase their chances of finding more gold to sell. They're also not allowing their managers to take a quick payout. This is to say that the risk-reward trade-off of expanding business is much higher than the risk of not seizing that opportunity. Think about that. The payoff would be much greater even if they just simply waited with what they had. They're building inventories in this scenario. What if I told you that we've entered these times? What if the cost of labor is still so high that in order to extract 1 more ounce of gold, it minimally costs the average miner $2,000 to do so for every single ounce? And that is between extraction to refinement. That would mean gold should be valued at least $2,000 wholesale before it makes it out to any dealer. And a dealer is whom sells to you. What if I told you we should also expect more inflation in the market? You know this already. Unemployment payments on the rise, loans being paid with government assistance, the Fed buying distressed assets from the bank, more forgiveness loans to cover payroll costs. The government never had any of this money to begin with. They didn't raise enough taxes to cover this bill. They're printing this money. They're creating this money from thin air. You should be allowed to assume that inflation will continue to rise so long as there's money that's entering into this market. Newly created money. Economics 101. We learned the quantitative theory of money supply. Added money into the market above what is already in the system, minus any additional output, directly inflates everything we buy. Directly relates to inflation, especially when all other buying habits are kept the same. So we're keeping all factors that exist in the market, output, productivity, and we're increasing money. And when we do that, we get inflation. When we have less productivity, we also can increase inflation much more rapidly by increasing the money supply. In these times current, we project we will have less 30% output and increase money supply by already what is 20%. This is the M3 monetary supply. That's pretty much all money that's out there, as liquid as they come. Deposits, commercial paper. Should we not presume we're headed towards at least a 20% inflationary consequence? Age-old wisdom tells us that precious metals are one of very few things we can buy in these times when inflation is high and we have to protect our savings. Oswath de Morteran, whom is the godfather of finance and asset valuation, has a video out there detailing some of the factors of inflation and how inflation is the hidden tax on wealth that we don't feel right away. In his video, he'll tell you all about how additional money supply makes its way into the hands of the general public. So I'm not going to go too much into that. I think he does a great job at illustrating how and why the government tends to lie when recording inflation data, and how they intend to publish their findings for these coming years. There's some shifty people indeed. You should look him up when you get a moment, especially if you're interested in learning from a great teacher that is responsible for a lot of my own analytical skills today. Right now, some of you might be thinking, okay, so printing money into the market, I get that. But what does more money have to do with anything? Doesn't this mean that more people will have money to spend and therefore boost the economy? That is the hope, actually. It's the hope of most economists in the government and most politicians. The reality, however, is that money that is added into the system without the creation of something of value in exchange for that money actually leads to handicapping the value of that same money when spent by the next person you pay it to. In my theory of value, it is the real effort you put forth in earning money that decides whether or not something even has value. And this makes sense if you think about it. Value is the worthiness something has to be traded for a sacrifice you've already made, which is directly proportional to the sacrifice you know you'll have to make in the future to earn that same amount of money over again, so you may recover what was spent. When cash is given more freely and comes with less cost in the process, the money itself loses its luster. Because of this principle, the added money from nowhere may not actually be borrowed, and it doesn't have to be necessarily, but it does work out mathematically similar as borrowed money or a loan from yourself in the future. Think about this. What if the meaning behind every and each dollar purchases less and less things? Less value, right? That's how you end up paying this loan back. If $10 buys you a pound of chicken, or a 12-pack of beer, or a pack of new socks, all of those items going up to $11 in the future, that's one whole dollar above the $10 you originally paid. Nothing else changed in the scenario. What you just did is you paid a 10% interest on a loan you never agreed to take. It used to be, for many years, if you wanted to avoid this inflationary consequence, you could reduce its impact by taking the money you don't have to spend and investing it in treasury bonds, which the government guarantees the full amount back, plus a healthy sum of interest payments. It used to be that way. This was definitely a great instrument for overcoming inflation, especially if you're a retiree, whom are really risk averse, really fearful of risking their nest egg in the stock market. But that whole concept is gone now, and you can thank the Federal Reserve for that. If there was one thing you were to take away from this podcast, it should be the axiom in that the Federal Reserve has been an agent for lowering interest rates over the last 50 years, to the point where inflation is now higher than the interest payments you receive from buying treasury bonds from the federal government. Imagine now, if you could see crisis coming and inflation around the corner. Perhaps you have a crystal ball on the market, but not necessarily over the stock market. You just know when things are going to get tough, and that in the coming years, things will become more expensive. If you could see all this coming, the most savvy investors would advise you to invest in municipal bonds, treasury bonds, CDs, and maybe debts held by really large, important businesses. You might even recommend gold. For a lot of people, those are quite a number of options to choose from. So even in bad times, a lot of people with money could still find ways to weather that storm. Now imagine that the interest rates of every single one of those instruments is now below 3%. True inflation is at 6%. You're only sparing yourself from an onslaught of that additional 3%. Today we have all the same people and much, much more 50 years later. The middle class around the world has grown, and many accounts with savings are still looking for the same things, right? Shielding against inflation. These folks need and want somewhere to go. It's as though we've taken all these conventional options off the table and funneled a ton of more people into a direction of only one or two areas where they can shield themselves from inflation. 10 times the number of people in this world with more income. That's not the population, but that is the population that belongs to the middle class. We've grown the middle class over the last 50 years. So I wanted to verify all of what I just said here. There's a lot I need to add and a lot more many of the greats out there that won't tell you. Inflation does have an effect on the price of gold, but it's not visible unless we look at the longer time horizon, like 5 to 10 years. In the meantime, inflation isn't as heavy of a factor for pushing up gold like you might think. Or maybe it is. And maybe it's just that my models aren't capturing that because the government inflation statistics are grossly underestimated. That could be true. But let's not assume that for a bit. Let's give them the benefit of the doubt that all the information they have out there is accurately reported. Sure, okay. In my models, you can hardly see where inflation is pushing up on gold's base value. And what's more is the real value of gold's appreciation, which is percentage gain in price when we subtract out inflation, is very sporadic and doesn't have much order based on any amount of inflation observed in the markets. Most years, gold loses real value and decreases in price due to lowering raw demand. And then it's in this timeline, we find that it's punctuated with different periods of history where there will be 4 to 5 year spans of massive real growth or growth above the rate of inflation. This can be upwards of 60 to 80%, which is exciting to see. And though it can't really be predicted accurately, we do have enough data to reflect that it will happen. In the last 54 years, the price of gold's real value above inflation gives you an annual 6 to 7% return. So every year for the last 54 years, we've compounded 6 to 7%. That's phenomenal, if you really think about it. Seriously, compare that to the S&P 500 and the Dow Jones index. This is to say that if you held onto gold for 54 years, you would have compounding interest, like I had said. However, the reality still is that this calculation is smoothing out the massive spikes in those random years and pairing them up against the years where we have this minimal growth or even this subtle decay against gold's value. That really happens, where inflation is allowed to catch up. If we look at the long term of 100 years in the value of gold, we see the annual return is smoothed out to even less than 6 to 7%. In fact, it's much less. The annual growth between 1915 to 2019 is between 1.3 and 1.5%. That's the real growth above inflation, accounted over 100 years. So here's where the news gets really exciting. Timing matters. Not just the exact timing before a massive run-up, but the era in which you decide to get into gold, that matters. If we were to segment the last 100 years into 10-year windows, each time we move to the next 10-year window over, we see that it is more common to have high spikes in the price of gold, which these gains will aggregate to greater gains across each segment. So from one segment of 10 years to the next 10 years to the next, we see that these average gains over those 10-year periods are on the rise. They're more frequent, and they compound with one another. Those are really great things. But what about this whole talk with inflation? We've had inflation all throughout history, and it seems as though the price of gold has been all over the place. I mean, if you took it to a graph, you can clearly see that. So it appears so, sure. I would argue that as the Earth gets more populated, there are more people that could potentially be in demand for gold. But also, that more people are mining for gold or offering those investment opportunities that compete with gold, whatever those other investment opportunities may be. And certainly, inflation has been fought back by merely moving American factories overseas to take advantage of cheap labor. So there you might see the mitigation of inflation in the US, in consumer products and consumer goods. So that has brought us that the last 20 years of inflation has been muffled by industries evacuating the US. But we have to understand that all these factors catch up and we exhaust the benefits of these events. The pendulum does tend to swing back the other way in gold's favor. As the earth is more industrialized, there are more countries across the world with people that can afford to buy gold. We've covered that. And of course, also over time, even though we've developed more productive means of extracting gold, it still remains that for every ounce we pull from the mountain, that is one less ounce we'll ever be able to add into the known gold reserves ever again. There's less and less available for us to find. And it gets harder and harder for us to mine for gold once we've stripped the earth of all the easy finds. We have to get more inventive. Operations get more costly. The digs require us to go further. So this is an exciting amount of pressure beneath what is the price of gold. So couple this with the growing demand among greater number of people around the planet, and all of us experiencing some amount of crisis together in the world of finance, in the jobs market, all over the place. That's one hell of a commodity that shines brighter than the rest. Every new generation that decides to hold gold will have a higher annualized return. So doing so within their lifetime will mean that they have been more of a success holding gold than the generation previously. So in all this, I'd like to conclude this topic by saying this. There's much evidence to depict that the price of gold has less to do with printing and inflation. Though it does provide the initial spark before the piston hammers down, the actual fuel that drives the value machine in gold is in fact that there is less and less of it for us to mine, and more people that want it all for the same reasons: to hedge and to thrive. In my models, I have different methods to go by for illustrating where the price of gold will go in the next 5 years. Some models attempt to use inflation solely as the predictor, and they miss 60 to 70% of the information of the big picture. They're still usable because it can be a conservative estimate, and based on those conservative estimates, we have an expectation in price of $2,200 to $25 within the next few years. As inflation pushes even higher, it has less of an impact on the price of gold for this current year, and that's likely to do with the fact that earnings have also stagnated in times that we pursue inflation. So think about that. When are we most likely to have inflation? When are we most likely to print money and add it into the system? It's almost always going to be in times of crisis, when there are less jobs, less money to even go around. People are earning less. So the money printed is easily being spent. There's no savings. This sort of has a counter effect because there's less productivity. Getting down to the brass tacks of this discussion, when all the dust clears from the trampling and sporadic sell-offs that we're actually seeing currently, there's going to be a thick layer of investors that we reveal with nowhere else to turn. This is going to serve as the base of Mount Everest in our next major gold rush. This is my belief. Special shout out to the 15 new subscribers that we've gained this week. Thanks for becoming part of my mission and my story. I hope I'm keeping you entertained just as much as I'm able to provide this content for educational purposes. Keywords there. Please leave a like and let's continue to spread our influence. Thank you so much.